All right, hey guys, this is Toby Mathis, and I'm joined by Jeff Webb. This is Tax Tuesday,
Good afternoon.
bringing tax knowledge to the masses again. So I hope you guys are doing great. Uh, let's see, there's a bunch of people already asking questions. I want to make sure you guys can hear us well and that we're coming through loud and clear. So if somebody could give me a confirmation on that, that'd be great. Otherwise, I'm going to crank this puppy up. Oh, good. So it looks like it's coming through good on my side, loud and clear. Fantastic. So first off, happy holiday season. I hope you guys are done with your shopping. All right, maybe not.
I write checks.
Yeah, Jeffrey. It's horrible. All right, let's just jump in. This is Christmas time, so we're going to start giving the Christmas presents. So first thing is ask lots of questions. We are going to answer your live questions as quickly as we can. We have a bunch that were sent in to the Tax Tuesday at andersonadvisors.com, which we'll go over those ones first. If you need a detailed response, which is some of you guys send in some crazy difficult. If you're platinum, it's free. If you're not, then you got to be platinum. And if it's really crazy where we're doing a bunch of analysis and we're going back and forth, you're going to have to be a tax client. All right, this is fast, fun, and educational. So we just want to give stuff back, help people do as best as they can with what they got and keep as much in their pockets as humanly possible, unless you like giving it away, in which case, bless you. I'm glad that you're paying your taxes and overpaying your taxes. All right, let's get rolling. And I see lots of people asking questions already, which is good, but we're going to go with the ones that we already sent out. First and foremost, if I can get these slides to, there we go. Questions that we're going to go through today is my wife is a dentist on W-2 working for a private clinic and does not get any benefits. That stinks. Only this year, after 3 years of service, she got a $10,000 SEP IRA from her employer. I was looking for more retirement options for her. They are out there. We'll go over those. Number two, my siblings and I have inherited farmland, real estate, which we own an LLC. We rent this farmland to tenants per a crops share agreement where we participate in some of the expenses and profits on a 60-40 ratio. My questions are, since this is an LLC, is a pass-through entity publishing K-1s for the year eligible for the 20% write-off? And we'll go over that. Does the fact that we share crop have any effect on this pass-through? Yes, and I'll go over that. My question pertains to health insurance reimbursement. I have a C-corp and an S-corp. I pay myself a modest income of $36,000 a year. I qualify for a subsidy of $125 per month, leaving me to pay $386 per month on my health insurance. Can I reimburse myself from my C-corp for the $386 out-of-pocket premium I paid at Blue Cross Blue Shield and write it off of my C-corp? We will go over that. You guys ask good questions, I'll tell you that much. I am a realtor. I normally make edible baskets and take to my past clients around the holidays. That's really nice of you, first off. I also cater lunches for businesses that I obtain clients from. Can I write off these expenses as advertising? We'll go over that. You're thinking right. You guys are getting tax-wise. Are holding companies only for rental LLCs, or can they also hold active business LLCs? We will go over that. What taxes will revocable trust beneficiaries typically have to pay upon distribution? We'll go over that one too. From a tax perspective, would it be better to gift a beneficiary from trust assets while the grantors are still alive? Love those questions, and that's going to come up with, we're going to have some options here. And then which IRA, what checking privileges do you recommend? Jeff, I'm just going to answer that one. Mine. I'm just kidding. No, we'll get into that. We definitely have some thoughts on that. Let's see. First question that was asked. You guys, first off, thank you for asking the questions. Second off, here we go. My wife is a dentist on W-2. So she's a W-2 employee, and she's not getting any benefits. So we're looking for retirement options.
Okay.
So first off, if you do not have another company, then you're going to be stuck to the realm of IRAs. And frankly, if they're already putting $10,000 in a SEP, really what she's looking at is whether she qualifies for a Roth IRA or a traditional IRA.
Right, and I think in this case, if she's a dentist, not knowing exactly what her W-2 wages are, she could be running up against other limits because she's eligible for an employer plan already.
Yeah. So let me throw some ideas at you. First off, if she's W-2 and she's not getting any benefits, then it's costing the employer money and it's costing you money. So depending on how extensive that employer watches over her, and in the case of professionals, she has to exercise independence. I would say she'd probably qualify to be an independent contractor.
Yeah, I agree with that. We do that a lot, especially in the medical profession.
Yep. So if she's an independent contractor, she can set up her own S-corp. And if the S-corp is doing the service, then she can adopt a 401k, and she could put the first, depending on how old she is, 18,500 or 24,000, and those are going up next year, by the way. 24,500 is going to jump to 25, and the 18.5 is going to go to 19 on a 401k. So she could actually put her own money in. And then the other benefit is the employer, the S-corp, could also deduct and contribute up to 25% of that amount directly into her retirement plan. And the other benefit of it is that if she does that and she makes a bunch of her money go away out of the S-corp, any remaining profits in that S-corp can flow out to you as, at least it's not subject to self-employment tax.
Right. And it's also going to be so let's assume that she's receiving $100,000 of W-2 wages a year. If the employer pays it to her company instead, she's not required to pay all that out to herself.
No, she could actually sit in there and let it sit.
She'd let it sit in there, which would possibly entitle her to some kind of what we're going to talk about later, the 20% deduction.
Yeah, now here's the cool part, the 20%, and she would be a specified service business. So that 20% is that 199A you've heard us talk about.
Yep.
It's a pass-through deduction. As an employee, you're not eligible for it. It's not eligible on wages, but as an S-corp, she would be. And so she could get a nice little deduction on that 199A if your taxable income, your total taxable income between the two of you, is below $315,000 for the year. Now, this is where it gets really crazy. We can get you down to that 315 because you can always give it away, you can put it in. But if she's making good money, and she's been making good money, we could do what's called a cash balance or a defined benefit plan and perhaps write off the entire amount that she's receiving and lower your guys' total taxable income. So like we get to some pretty crazy results here where you're going to be, if we can change her from a W-2, and by the way, they're going to look at this really close because they're going to see whether there was a reason to be switched out. This would actually be a good reason to do retirement planning.
Right.
Just for taxes isn't going to do it. But when you say retirement planning and autonomy and et cetera, then there can be some pretty significant tax benefits. Now, the drawback of no longer being an employee is she's responsible for her own insurance. She's responsible for herself. And there would be no more SEP IRA for her. But of course, she's dumping a lot more than that into her own retirement plan. But I'd be remiss if I didn't point that out. Somebody else is responsible for her. So this is something where it would be good to have a conversation with a professional. That's what we do here. Reach out to us. We match you up with somebody. Number 2. I have a slow working, Jiminy Christmas. This thing's just wanting to.
There we go.
Yeah, my buttons aren't clicking. All right, my siblings and I have inherited Farmland real estate, which we own an LLC. First off, when you inherited it, it stepped up in basis, so don't forget that. We rent this farmland to tenants per a crops share agreement where we participate in some of the expenses and profits on a 60-40 ratio. And then the questions are, since it's a LLC passing through K1s, do you get the 20% write-off? And then does the fact that we share crop have any effect? So there's rental income coming in from this, and there's active. And the regulations actually address this. I don't know if you want to, have you played with this at all?
Well, from what I've seen is rental income is subject to this 20% deduction, just as every other business type of income is.
Yep.
One thing I want to clarify, though, is your first question, since this is an LLC, you don't have to be in an LLC.
You could be a sole proprietor. You could just be getting it on your Schedule E, even through a disregarded entity or through nothing.
So while they call this a pass-through deduction, it needs to be named something else.
What they should say is something other than right onto your 1040. It has to go through one of the schedules. So Schedule E, Schedule C, trying to think of anything
So
else.
yeah, this is primarily a business deduction. But rentals usually aren't considered business income, which makes it a little strange.
So all we have is proposed regs, and what they said is you aggregate it for sharecroppers. You net it out. So you take a look, and it's the net profit off of both, and yes, you get your 20%. See,
that was a long answer to get there.
Yeah, but I like it. So you get a huge benefit, and don't forget, when you inherited that puppy, you stepped up your basis. Don't forget that. That's a huge one, which means the new basis is the fair market value on the date of probably a parent passing, but whatever it was. All right. My question pertains to health insurance reimbursement. I have a C-corp and an S-corp, so right off the bat, we already know that we're dealing with the difference between S-corp and C-corp when it comes to reimbursing. I pay myself a modest income, more than likely out of the S-corp. I qualify for a subsidy of $125 per month, and I'm assuming that's on the marketplace.
That's what I was thinking.
Yeah, so leaving me to pay $386 for my health insurance. You may want to look at some of the faith-based plans. They're even less than that. Can I reimburse myself from my C-corp out of pocket premium? I pay Blue Cross Blue Shield and able to write it off from the C-corp. So the answer is it depends. First off, you can't have any employees in any of these companies other than yourself and a partner. So if it's you and it's just you, nobody else, then the answer is yes. If it's you and a spouse, the answer is yes. If it's you and a partner, the answer is yes, because technically you don't have to comply with the ACA. If you go above that, then you're in ACA territory and you're going to have to provide minimum coverage, although the Department of Labor and the IRS don't agree on this, and there's a bunch of stuff going back and forth, and they have this weird, you know the term for it, less than 50 employees. What do they call that?
Oh, they called it the small business exception, or
it's some goofy thing where they actually, I thought it had like QWERTY. I always think of QWERTY because of the keyboard, but it's some weird qualified this, that, or the other. What the point is that if it's really tough to get coverage if you have less than 10 employees.
Yeah.
And you can't like it, and you're supposed to be getting that coverage to qualify for ACA. So if it's just you, we don't have to worry about that because you're exempt. And then you can write off out of your C-corp. It can reimburse you anything that comes out of your pocket for premiums, co-pays, deductibles, non-covered, whatever. If it has to do with with health and the fixing your body or keeping your body healthy, then chances are it's going to be deductible. And especially if a doctor prescribes it or if you're under the care of a medical professional. That's really the only way I know of you can write off like club membership dues if they prescribe it, you know. But.
Yeah, the only issue about writing off the out-of-pocket expense is we really don't know what your credit's going to be until we complete your 1040. Mm-hmm. So while you're getting that $125 a month subsidy, what your credit actually is could be more, it could be less than that.
Yeah.
Depending on your total income.
But we can keep your total income pretty darn low if we're reimbursing through a C-corp. So you're actually doing it right. C-corp probably manages the S-corp, have a management agreement, make sure it's in writing, make sure you're invoicing. And boy, yeah, you could do some pretty amazing things here because if there's not just the 386, but it's anything that comes out of your pocket, including the deductibles and co-pays. And
right.
Like if it's dental, shoot, they only cover about half of a procedure. So you could do some pretty amazing things with this one. So the answer is it depends on your situation. Hopefully it's just you and a spouse. And then you can do whatever you want. If it's not, then we just have to be cognizant of the fact that we have to comply with the ACA, which case the answer is still yes, but you may have to offer that benefit to other employees. Employees that you'd have to offer the benefit to are 30 hours or greater.
Right.
All right. I am a realtor. I love the way that they do it in all caps.
I did like that.
I normally make edible baskets. I like that part. You can send it right here to Anderson if it's cookies. And I take to my past clients around the holidays. So that's really nice of you. Is it past clients or even do your regular clients? I also cater lunches for businesses that I obtain clients from. Can I write off these expenses as advertising? This is awesome. Jeff, you know the rules.
Okay. So edible baskets that you're creating, you're going to be able to write off your cost of those baskets
Up to
up to $75.
$25.
That was 75. Okay.
Gifts. They didn't index it for inflation. It's been the same thing for like 50 years or some ridiculous term.
Okay.
Or you make it as advertising. Either way, you're going to be writing it off. But you have a gift amount of $25 that you don't have to report, that you just write off per person per year. So if you're making edible baskets, depends on what you're using for the contents. But my guess is you could write it off under either of those two sections.
Now the catered lunches, that's going to come under the meal rules.
Mm-hmm.
So that's going to be, you're going to be able to deduct half of what you actually paying for those catered lunches. There is a 100% exception, but that's got to be lunches open to the public, like open houses, things of that nature.
Mm-hmm. Now what they're saying is, can I do it as advertising? I think what they're saying is, I know that people try to do this. And technically, if you're trying to generate business and it's aggregated into one expense. So what I'd be doing is seeing if you can't, if you're catering a lunch, it depends on how it's being broken out. If it's food is separate from the room, I think you're going to have an issue.
I agree.
If the food is included in a room fee and you have a basic, like, hey, you have to meet a minimum of food and beverage, then I think you're okay.
Yeah,
I think you're right.
I completely agree with that.
Yeah. So the answer is it depends, but chances are we'll find a way for you to write it off if you're working with us. If whoever your accountant may be, that's where they get their pencils out, sharpen it up, and make sure that they're giving you good advice. All right. Are holding companies only for rental LLCs, or can they hold an active business LLC? This is where I get my handy dandy pen out. And we're going to walk you through this. The reason that we typically have a holding LLC is because we'll have a bunch of LLCs in different states or holding different assets. And let's say each one held a little house. Pretend those are houses. And you have the holding LLC. Here's you out here smiling. If somebody comes after you, then we want to stop them. And usually we use a Wyoming holding entity or a Nevada entity, because they cannot take the LLC away. The other reason is it makes a single entity for taxation if you're doing a 1065, a partnership. So we only have one tax return. If this house down here has a horrible liability occurrence, it stays inside that box. It doesn't infect the other boxes. Now, what if I own shares in IBM? And I own a bunch of IBM shares. Should I put that into the holding company too? You could. The problem is let's say that they make an argument that you should have, that they should ignore. We had this piece of property, and they make an argument that somehow you should ignore the LLC because you forgot to do some paperwork, or they start trying to pick through it in court, and they're trying to get to this guy up here. They don't know about these. If you have a bunch of stock sitting in the Wyoming entity and they start doing discovery, you may put yourself at risk on losing that, because if they break through and they get into the holding, then they could perhaps take it. Now, it's highly unlikely. So it's always a facts and circumstance test as to how aggressive you want to be in your asset protection planning. This, to me, looks like you have some assets. Is it worth putting your stock at risk? It depends on how much it's worth. If it's $50,000 of a private company, or if it's $5 million, I'm going to give you two different answers. If it's just, hey, this is just my corporation, and I have a C-corp or an S, it's going to be a C-corp. It's not going to be an S, because an S-corp has to be owned by you. But let's say we have a C-corp that's owned by you, and you put it in there. No, really, no harm, no foul, because nobody's going to want your corporation stock anywhere. You're using it, probably you're keeping it fairly lean. So you can do both. It's just whether it's prudent to do both is really up to you as to what you're willing to risk. So anyway, Jeff?
Nope, I'm good.
I'm sorry. I go crazy. All right, you can do this one. What taxes will revocable trust beneficiaries typically have to pay upon distribution?
Well, the whole point of a say it for me. Revocable trust is what I call it.
Yep. Say revocable, revocable, whatever you want. The R trust.
The whole point behind that is the grantor, the person who actually funded that trust, is still technically the owner of those assets.
Yep.
So any income being generated under that trust is going to be taxable back to the grantor, not to the beneficiary.
That's called a grantor trust. Whenever you hear somebody say grantor trust versus non-grantor, what they're referring to, does the grantor get the income? And if it's a grantor trust, then they ignore it and they just treat it as you.
Right.
But now you're saying a trust beneficiary upon distribution. I think they're talking about when somebody dies.
So once somebody dies, it's no longer a revocable trust.
Now it's irrevocable, which means, is it a grantor trust? Well, they're not obtaining, they have no power over it anymore.
I've heard it's called a credit trust, an AB trust,
credit shelter.
Credit shelter. Yeah, there's 100 names for what it is now.
It's irrevocable. Nobody can change it, and the grantor is now deceased, which means it's a non-grantor trust, which means it's flowing to you. So if the trust makes money, generally speaking, it's distributing all the assets and the income to the beneficiaries, and the beneficiaries pay tax in proportion to the amount that they receive. If it's just sitting there as an irrevocable trust and it's not distributing anything, then the trust would pay tax on it. Or it could K1 out the beneficiaries.
Right. Some trusts are required to distribute their earnings, whether they have or whether they actually distribute or not. So at that point, what we call simple trust, the beneficiaries are being taxed on their earnings. The one exception is capital gains remain with that irrevocable trust. It's considered part of the corpus, the body of the trust. So until that is actually distributed out to the employees, the beneficiaries, the trust will continue to pay tax on it.
See, you guys ask a simple question, and unfortunately, there's always facts and circumstances. But generally speaking, if you don't want to pay tax on the trust level, distribute it out to the beneficiaries, and it's always going to be the beneficiaries who pay tax. If it is a revocable trust and you are the grantor and you're giving money to beneficiaries, that is called a gift. You are the beneficiary during your lifetime and you're just giving trust assets away, then you're just gifting, and you would pay tax on that, but they wouldn't pay anything on receiving that. If it's a grantor trust and it's your grantor trust, until it becomes irrevocable, until they become the beneficiaries, we're not worrying about tax to those recipients.
Right.
All right. Fun stuff, guys. All right. From a tax perspective, would it be better to gift a beneficiary from trust assets while the grantors are still alive?
Boy, deja vu?
Yeah, what? Same thing?
Yeah, so would it be better to gift a beneficiary from the trust assets while the grantor is still alive? I have mixed feelings on this because I've kind of dealt with this. If the grantor is in poor health.
I know what you're talking about now. It took me a while. I'm a little bit slow today, guys. Jeff's referring to something that we were talking about.
Yeah, if the grantor is older and poor health, then no, you don't want to distribute those assets if you can't. There's multiple reasons to distribute to the beneficiaries. You may just want to be able to, if it's your children, to benefit those children while you're still alive. Maybe you'd rather see them get some of it while you're still alive than after you pass. However, if you wait till you pass for them to obtain your assets, they do get that step up in basis, and that could be a considerable benefit to them.
Boy, I just dealt with this actually on a question that we couldn't answer a few weeks ago. I've been going back and forth with the client. It was some Oregon clients. We were talking about the inheritance tax, which Oregon still has a inheritance tax, which is called the estate tax there, but basically it's an estate tax. They call it the inheritance tax, excuse me. It's on $1 million. So anything above that, you're getting hit pretty hard. And so here's the competing interests. If you die with an asset, the basis steps up. So let's talk about having a house. And I give the house to Jeff during his lifetime. Let's say I'm Jeff's dad and I'm giving him the house. Then there's no 121 exclusion. Jeff is getting my basis in that. Let's say that I bought it for 30 years ago for much, much less than what it's worth now. And he's not getting taxed on it, but he's not getting any benefit, and I'm not getting any benefit. Now, if I pass away, Jeff owns the house. He gets no step up in basis. I've already given it to him. And he could do whatever he wants with it during his lifetime. So if I give him the house and I say, here, Jeff, I'm going to give you the house. And he says, great, Toby, you're moving out tomorrow. I'm kicking you out. There's not much I could do about it unless I reserve a life estate. Or put it in a qualified personal interest trust, something like that, or personal residence, QPERT, qualified personal residence trust, where I get to live in it for the rest of my life. Now, we don't want to lose that step up in basis that you get. So, let's make it in reality. I'll give you a real life situation of somebody who inherited the dad put some buildings into a limited liability. It was actually a limited partnership, but it could have just as easily been a limited liability company. And they gave the interest to a bunch of siblings. And they did not get a step up in basis. So when the siblings sold it, they ended up having tax obligations when they started selling off the buildings years later. And that kind of stunk. And the reason they did it was because they were worried about the estate tax, but there really wasn't an estate tax to worry about. It was just some advisor getting a little, jumping the gun, getting out over his skis, getting worried about something. And it caused tax harm. The only time I would actually recommend that somebody starts gifting the asset is if we know for sure there is going to be a tax hit. So mom is getting older and I am going to pay $140,000 in tax. I just did the numbers on one of these, and this is about the scenario. Is that more than I'm giving up if I have a step up in basis? And so I look at it and say, if I gave up the step up in basis and just transferred it now and I sold it, what would my tax obligation be? And if I ran the numbers and it was less than $140,000, then I might do it, assuming that mom's old and in poor health. Because I'd say, hey, I'd rather not get killed in taxes. Right. It's not worth it. I'd be better off. Here's a thought though. Whenever I see those situations, I always go to them and say, what are you trying to accomplish? Why doesn't mom sell the house on an installment sale with the right to occupy and pay rent? And that way we froze the value of it. It stepped up at that time. Mom has an income stream, and then you just gift the income stream when you pass. You kind of get the best of both worlds there. You got it out of your estate. You froze the value of it. Anyway, so and there's some other little tricks up our sleeves too that we could use.
And as far as gifting to your beneficiaries or to whoever, one thing I would recommend based on what Toby just said is I don't think it's usually wise to gift greatly appreciated assets.
No.
Because you're just transferring your tax liability to them.
Absolutely, 100%. 3 rules of anything tax or financial related, which is calculate. That's where we just get our pencil out. And in most states, I think there's 14 states now that still have an estate tax. Most of the time, the federal taxes, unless you're over 11 million, it's not even an issue. Right. If it's married couple, unless you're over 22 million, we're not even worried about it. But you may live in a state that still has that stupid estate tax. So like we had the Oregon, they're at $1 million. Some states are still floating around out there. So you always just get it out and say, what would I be looking at? What am I giving up? And you don't make a hair trigger reaction. All right. From what taxes? Oh, did I go backwards? Here we go. Which IRA with checking privileges do you recommend? Did we get through all the questions already?
Yep.
Wow. Seems like just a blip in time. That's crazy. We work with, somebody's asking a question. We have a lot of questions. We'll get to those now. And Amir, you can ask questions. The route that we go is we answer the questions that were asked via email. We answer the questions that were emailed in during the week. And then we go on to the live questions. So we're going to get to you. We're not going to get off until we answer all your guys' questions. Which IRA with checking privileges do you recommend? IRA Club is the one that we tend to refer to. That's Dennis in Chicago, super nice guy. And that's probably where I would go so hopefully whoever's looking. And that's not saying there's good and bad. There's good and bad everywhere. It's whoever you're comfortable with.
But it's usually going to be somebody who helps you with self-directed.
Yeah, you're doing a self-directed. And realistically, depending on what you're trying to accomplish, if you want check writing privileges in an IRA, I'd probably say you're better off going with a 401k and not having a custodian.
Yeah.
So, that's
Yeah,
always.
you're not going to be able to go to the bank and ask for an IRA with checking privileges.
No, what you do with an IRA is you have a checkbook LLC. You open up an LLC in the IRA, and it has that. Or
That's brilliant.
just do a 401k.
Could you do a 401k?
Yeah, I think we could handle that one. Yeah, and then you get rid of the custodian. So if you want to buy things on the weekends, all right, we have a bunch of questions. You can email in if you want your questions. We're about to go through a whole bunch, and then we'll get to the live guys. And we have a bunch on the live ones too. We're gonna bust through these. So questions, you send to Tax Tuesday real quick, and then I'll go back over this too. We did a year-end planning recording, and you can still get that at andersonadvisors.com/year-end-tax-planning-2018. I'm going to shoot my my guys that do it. My tech guys love putting those dashes in there. I'm always like, you're making my head hurt, guys. Email us or visit Anderson Advisors. But I did about an hour and a half, I want to say, on year-end tax planning, maybe, I think, right around there. A whole bunch of ideas. I think I hit over 20 strategies for the year-end. There was an offer in there, which I'm afraid is over. We are booked till the end of the year with our tax guys. Our tax guys are slam, bam, thank you, ma'am. It is not even funny how packed these guys are. Jeff just keeps looking at me going, please don't send me any more people.
You're killing me.
Yeah, you're killing me, Smalls. But you could always try reaching out to an advisor. I just don't think you're going to get a tax planner. We'll do our best to help you, and guys will ferry questions back and forth, but you're not going to get a consult at this time of the year. That's why we tell you to do it back in October. All right, so let's go back to questions, and let's start going this. I have inherited a property in Virginia, a farm and a home, and it has a life estate of a 90-year-old. What is my risk? Well, this is kind of odd. So you inherited property, and you have the remainder interest. The life estate says she has insurance to cover herself. Question: how should I address the issues in this case? She also owns 25% of a separate farm with buildings and other stuff in a corporation. I've also inherited 1/9 of another 25%. Wow. The one does not have a life estate. How should I structure these assets, and how long does it take? Very, very interesting. So here's the deal. Somebody's got a real estate attorney, and they're going to town. And so what they basically said is, you get some land, but somebody has the right to it during their lifetime. Now that's marketable, which means if she lives there, she probably has the right to stay there. But if she doesn't, you may just want to see what it would cost to buy out that interest. And if she has insurance, probably to cover the property in her assets. So if she destroys the property, you're not out of luck. I would still get insurance on it. Talk to an insurance company about insuring your interest and insuring the structure so that you don't have to rely on somebody else covering it. How would I address it? I would just talk to her and say, hey, what's your intent? Do you want to stay there? Is there another way we can handle this? Then I also own 25% of a separate farm in a corporation. I'm wondering, so it says 25% of the farm, and then they got a piece of the other 25%. If you're in a corporation, there's really not much I'd be doing, except that I'd be worried that if it's a farm and it's land, I don't particularly like it in a corp. I would at least drop the land into its own LLC, and I don't know, it'd be really tough to figure this one out, because you have a taxable event if you take appreciated assets out of a corporation.
Right.
So,
and I'm not sure if this is a actively farmed property.
yeah, I would say we'd have a conversation, because what we may do is I'd probably set up an outside LLC and buy the farm from the corporation on an installment sale, just because I want to get that real estate out of it and set up a rental agreement. What would I do with my other interest? I'm assuming that it's the other 25%. So that's going to give you some like 27, 28%. And this one doesn't,
And I'm curious as to how property is titled also.
Yeah, I'd want to take a look at a number of these things. Yeah, I'm thinking that if it's in the corporation, that kind of sticolas, but we'll have to take a look at it. It's a great issue, and I love the questions, but there's a lot of moving pieces here. Either way, we'd be able to help. Probably next year. That's what everybody wants to hear. Yeah, we can help you, but it'll be in January. No, we have 200 people that work here at Anderson, and if it comes down to it, we'll have an advisor working as the go-between. But the accountants right now are up to their eyeballs. For a trader, if I open an account in a personal property trust, then what is the role of the LLC besides using the LLC's EIN? Trustee of the personal property trust? No, this is what's beautiful. So I know what you're doing. So the personal property trust, we have to use them because the brokerage houses try to call you a professional trader and want to charge you extra fees. This way it can be Toby Mathis, trustee of the Mathis Personal Property Trust. But the beneficiary of that trust, I make the LLC and use its EIN. So its taxes are reported to the LLC. Here's why it's important. That LLC needs to be a partnership. If it's not, then any of the expenses are just going to flow onto my return, me, Toby, and I don't get to write off any expenses because there's no more miscellaneous itemized expenses on a Schedule A. So I literally lose 100% of my expenses. If I have an LLC, I'd want it to be taxed as a partnership, and I'd have a corporation be a partner and be the managing partner, would actually manage the whole account and everything else. So that's why we do that. Hope that makes sense. And it has nothing to do with the trustee. We're just trying to make the brokerage house happy without getting hit with extra fees and still allow us to have tax deductions. Is it deductible to the C-corp for expenses like utilities, insurance, homeowners dues? Also, is it taxable income to W-2 employee because home office is no longer deductible to them? Richard. Love it. Do you want me to whack away? Or
whack away at it.
I'm making you sit here and stare at me. So expenses that are business related would be deductible to the C-corp under an accountable plan. An accountable plan requires that there be an employee-employer relationship, and that can only exist in an S-corp or a C-corp if you're the owner. So if you have a C-corp and it's reimbursing you expenses, it can do so if it's a business expense. So like your cell phone, etc. If you have homeowners insurance and utilities and things like that and homeowners dues, then it could only deduct the portion that the business is getting the benefit of using. Now, this is one of those weird areas where everybody seems to be off their rocker in the accounting world when it comes to home office deduction. There's really 4 ways that you can have a home office deduction. You can have a cash registered in it. This is where I do all my business. This is where I transact all my business. You could have an administrative office for where you do your administrative activities for the business. And then that counts as a principal place of business for that business. Like a business can have multiple principal places of businesses under this standard. There's another one where you meet and greet customers, and then if you have a detached structure on your home that's used for business, then you can write off. So those are the 4 ways to do it. Everybody ignores that second one, which is the administrative office, because it's only available to employees of S and C corps or LLCs, taxes, S and C.
I think it was so ground into the accountants that your principal place of business at one time had to be where you did your work. We had fishermen that their boat was their principal place of business. They couldn't have a home office.
Yeah.
And those laws have changed.
But now you could. So that same guy, as long as he's an employee, so the boat would actually have to be in an LLC or a corporation.
Correct.
Or the fishing enterprise would have to, the boat could be in an LLC and it's being leased to the corporation. That corporation could have its principal place of business both on the boat and where he does his administrative services like invoicing, not on the boat.
Right.
It would have to be done at his home, and then the business can reimburse him the percentage of use of that space. So if you have a 5-room home and one of those rooms is being used for business, get this, you get 20% of all those expenses that can be deducted by the company, reimbursed to you, and under the regs, you do not report that anywhere. You just get the money. So it's deductible to the corporation, not taxable to you. That's called tax-free money. Whew, love that. Somebody else is a shareholder of a S or C corp, has a principal place of business, also work from home. Yeah, we just talked about that. That's exactly what we're talking about.
Right.
The answer is yes. And here's the thing. It's not just a shareholder. You said a shareholder of an S or C. It has to be an employee. So they would have to be a shareholder and be an officer, directors, employee. Do they have to receive wages? No. Actually, any compensation includes any fringe benefits or anything, whether it's taxable or not. So can a shareholder of an S corp deduct his personal health insurance if he is the only qualified employee? Does he need to establish a health reimbursement plan?
Well, for an S corporation, no, you can't. Well, you can't reimburse your own health insurance. What you can do is it becomes a deduction to the S corporation if you include those premiums as income to you personally on your W-2. Now you're saying, what's the benefit of that? That kind of washes itself out.
Because you can write it off.
Because you write it off on your 1040, not on Schedule A, right on the front page of your 1040.
Yeah, but that's only for the insurance premiums. You don't get to do the reimbursement plan.
Right. So any other medical payments that you make, or whether you pay them or the S corporation pays them, they're not going to be deductible to the S corporation.
Yeah. So Sammy, I would say you need a C corp, and you can still have a C corp and an S corp. You just establish a written relationship between them,
Right.
where you're providing management to the S corp, and that works. Believe it or not.
Make yourself an employee of that C corporation.
Yep. And you don't even have to take a wage. You could just be getting benefits, and then park some of the money in the C corp if you want. No reason you can't, especially if it needs it. All right. Here's another one. Land easement syndication. A lot of them offer 3 to 5 tax deduction, 3 times tax deduction based on professional appraisal on best use of land. What are the gotchas and things to look for? What percentage of those end up in an IRS audit? So you're actually talking about conservation easement. So it's land easement syndication means there's companies that get together, they buy up property, and then they give like the air rights and restrictions on building and all this stuff to foundations and public charities. Like what's one? Ducks Unlimited is one that always gets them because they like ducks. So you need to have lots of land open for the ducks. So 3 to 5 times. The average last year was 5 times the investment. So you invest $1, you get a $9 deduction. But that's aggressive.
Yeah. And it's always kind of astonished me that they use the best use value.
Donald Trump, President Trump, does this with every golf course. You can go read up on Mar-a-Lago. It got us, I think it was either a $6 or $9 million deduction because they said, hey, we're going to keep it as a golf course. You can't subdivide that thing out.
So you can have farmland that is usually valued fairly low.
Yeah.
But that's not its best use.
Right.
Best use might be to develop it into rent or residential real estate or warehousing where it's much more valuable. And that's the number that these conservation easements are based on.
Yes. But what percentage of them get audited? If you're really aggressive, probably almost all of them.
These easements have a pretty high audit rate.
But you're not dealing with the audit. You're just sitting back and you're getting a K1 on it. And my experience is they tend to win their audits as long as they're using qualified appraisals. The IRS is looking for people really going crazy, doing 20 times, even 9 times is too much. The ones that I've referred people to, and there's only a couple, are 4 to 5 times.
Yeah, I mean, I can't say how important those qualified appraisals are.
Mm-hmm. And I'm not going to recommend online, but if you send me an email, I'll introduce you to people. I do not get a dime out of these things. So I try to not expose myself to massive amounts of liability for nothing. But there's clients that have used it, and that's all I'll say is I've had clients use these that with success in executive level people, C-level people in publicly traded companies that have used it. If they're doing it, then I feel comfortable saying you could talk to the same people they do. That's about as far as I will go. And I will not recommend them as a great thing, but you could talk to them and I'd at least put you in touch. All right. Seeing as though the standard deduction was basically double, will the tax burden basically lessen by 50% as well? Oh, I would love that. Oh, no. No, the standard deduction is what you take or you itemize. And the standard deduction went up, but they didn't just do one thing. They also took away all the exemptions and exclusions.
Right. So there's no personal exemptions.
Yeah. And they took away
your state,
miscellaneous,
your local, your tax deductions cap now.
Yeah. State and local taxes are capped, which means your property taxes and your income taxes are capped at $10,000 if you're a married couple. $10,000 if you're a single person.
Right.
Yeah. Weird. And if you're married filing separately, that's the only one where it's $5,000 each. But that's the most bizarre stuff. So they took away a bunch of stuff too. So the miscellaneous itemized deductions, obviously the big one. They capped the SALT with state and local taxes.
Mm-hmm.
Overall, many taxpayers are going to get a little extra money. But in plenty of states, the average actually went up. So if you're in New York, Connecticut, California, a state tax place, Oregon, your taxes probably went up. Hate to be the one that tells you that, but we actually started those. I called it Tax-mageddon earlier this year. And everybody said, no, they gave us a big tax write-off. They gave the businesses the tax write-off. If you didn't set up a business, chances are you're not getting the best treatment.
If you live in Silicon Valley, this is going to be a really big blow to you, that state and local cap.
It's going to suck. And I have clients that pay property taxes in excess of $20,000 by themselves. Right. That now they just got that cut in half. And that's everything. Fun stuff. I currently have a sole member LLC established to run my real estate investments, but my wife and I are starting another line of business selling brokering life and health insurance. Should we establish a separate multi-member LLC or partnership, or is it better to pay her salary? Well, Louis, if you guys are going to make money at it, then part of it's going to be looking at your licensing and say what they'll allow you to be. Chances are they'll let you be an LLC and owned by the licensed individual. And more than likely, I'm going to tell you to be an S-corp, at least for tax purposes. That way she can pay herself a salary. She can put it all into a 401k if she wants. She could defer up to, again, $18,500 is this year. Next year is $19,000. If you're under 50, if you're over 50, you get a $6,000 catch-up. Add it on top of that, plus 25% of any wages the company can contribute. We can get to a good chunk of money into her retirement plan, which is only available if we have a business.
Yeah, anytime you're licensed to do business, like insurance brokers, real estate brokers, accountants, you really need to check what your state rules say that you can do, where you can put the income.
Yep. And you guys asking questions, and I see them flowing in here. Don't worry, we're going to get to everybody before we get off. So we have a few more to go through here. I have a truck registered with disabled veterans plates, and same with my house, which exempts all property tax fees. Would having your system support or hurt with the moving of a home into an LLC and land trust? I would not do that. If staying in my name, I save hundreds of my assets are known or creating covered and showing no assets, property taxes, motor vehicle. There's other choices, Eric. So he's basically saying, hey, I'm getting a bunch of benefit because I have disabled veterans plates. So first off, thank you for your service and your sacrifice. That it's not an easy path. So I've known a lot of disabled veterans, and sometimes it's not physical scars either. Sometimes it's the other ones that are worse. I had two very, very, very close people to me that were on full medical disability that you would not know it walking around. So I would not lose that benefit. I wouldn't mess around by moving that into trust, other than perhaps a living trust for your estate planning. Now, that said, it depends on the state in which you're in. There are states where they can't touch your house. So if you're in Texas or Florida, you have an unlimited homestead exclusion. If you're in Nevada, it's $575,000. So unless your house is worth more than that, they can't touch it. So anything else we do, we're looking at making sure that there's no income coming onto your return that would cause you to lose benefits. We're very cognizant of that, and we would make sure that we're working around that. So I would not ever put you in a situation where we would lose a benefit that you've earned or that you had a sacrifice that caused. So just so you know, that would be a consideration that we're looking at. All right. My S-corp is behind on paying the C-corp its monthly management fees due to some outstanding invoices. Would December 31st be the cutoff date to pay the C-corp in order to capture the tax deduction for 2018? Yes. And then it says, if so, can we carry this over to 2019? S-corp year is December 31st. C-corp year end is September 30th. Yeah, so what you need to do is make sure you're making a payment before the end of the year to the C-corp to get it out of this tax year for you individually. If you need to borrow money, do it. Just make sure the payment is done. If you need the money back out, well, you could pay yourself out of the C-corp. It could reimburse. Technically, it could loan, although Jeff would probably give me the stink eye here. Your audit risk is super low, and I'm not going to put you into something that would, but technically I think if you document the loan and you pay fair market rate, you could technically borrow the money back out, right, as long as you pay it back. Like, make sure that this is arm's length and that you are paying that sucker back. So Stephen, you could absolutely do that. The other thing we'd be looking at, by the way, is other assets where we could borrow money from. So sometimes we borrow from our 401k for nothing else to make a payment that's deductible this year. Yep. Sorry, we do it. Yep. And then you just have to pay back the 401k, but you're paying yourself the interest and you're getting a big tax write-off. So I would do that in a heartbeat too. All right. Anything you want to add?
No, in regards to that, I would not suggest that you borrow from your IRA, which means taking a distribution.
Don't take it from an IRA.
Even though you have 60 days to pay that or put that money back into another IRA, it's just a bad idea.
Yeah, it's only the 401k that we're borrowing. We can borrow up to $50,000 per participant, capped at 50%. So it's whatever's less. So if you have $100,000 in there, you can borrow $50,000 tomorrow, yep, and you pay it back over 5 years at federal AFR rates, which are around 4% right now. All right, I think they're around 4. I haven't looked at them.
I think you're a little lower than that, but. I think we can use the blended rate, but
interests have been going up.
I know.
Stinkola. All right. How much of our travel expenses, flight, hotel, gas, etc., can we claim on our taxes, or should we reimburse ourselves from our business? That one. Right. You can't write off any of it, and your business can reimburse you if it's business related. So you always do the accountable plan. I always talk about the accountable plan. Everybody says, what's the hell is an accountable plan? I've been doing this for 20 years, and every time I talk about it, they used to say, what's 280A? Now everybody knows what that is because of Airbnb, but it's like you get the reoccurring theme. So an accountable plan, you have to be an employee. You get to write off all your business expenses by reimbursing employees, and you're an employee. What is the best way to determine if a property qualifies for QBID? If it does qualify, is it no longer passive income, and I would have to pay self-employment tax? Do you know what that means?
No.
Qualified business interest deduction. I'm thinking that you're talking about 199A, and no, as long as it's rental, you're going to get the 20% deduction. So this is the 199A. I'm pretty sure qualified business income.
Yeah, it's 199A.
So rental right now under the proposed regs, they're saying qualifies with the sole exception of if you are a landlord of a commercial building with a triple net lease where you have zero skin in the game. That's the only way. That's the only one that I know of where it wouldn't qualify. Everything else you do. So as long as you manage the manager, you're fine. Holy crud. Somebody they emailed me a book. Oh my goodness. All right. My questions are regarding the subject of hiring the kids to do work for a real estate family business, online research, landscaping, where the residential real estate business is a single member, currently on a 1040 Schedule E. Question 1. If I'm not being taxed as an S-corp and my kids work for the business, should I issue each of them a 1099 form reporting their income? So the answer is, yeah, you can just hire them. They're not an employee.
Right.
So you can 1099 them, which is great. Where and how do I report that my sons worked in my business in 2018 and got paid? Well, that's that 1099. You're actually hitting it on the head. You're reporting it as payments to contractors, and they're going to report it on their tax return. If or once they get their 1099 form, do they need to file their own taxes? Yes. If each of their income was below $7,500, do they still need to file their separate return?
If their income is anything, they have to file their own return because they're subject to self-employment taxes.
Yeah, so they're going to have a little bit, like 14% tax, and that's the self-employment, old age, death, and survivors, and Medicare. And they will have zero taxes on their income because they're below the standard deduction for themselves. And so they're not going to pay any tax, which means put it in a Roth. Please put it in a Roth. Roth IRA, in case you're wondering. What other formal documents to the IRS do I need to provide? You don't have to provide them anything, but I would have a statement of their work, and if they do timesheets, that would be great. Some sort of invoicing would be awesome. Just something that spells out what they're doing and how much time they're spending, so that if you do get audited, you have easy backup. But I don't see these things getting audited that much. What's the benefit of the parents doing paperwork for the IRS to declare the $15,000 annual gift exclusion? There isn't. The annual gift exclusion gives you no benefit. You don't have to file anything for the gift exclusion. That's the amount you can give somebody without reporting it.
Right. So once you go over that annual exclusion,
Yep.
Then you have to file a gift tax return, which just reports your gifts for the year.
Yeah. So if you're under 15,000, you just don't report anything. If you go above that, then you have to count it against your lifetime exclusion, which is like 11 million right now.
Yeah, and that's the whole purpose of it. It's just to see what you've gifted over your lifetime and how it affects your exclusion.
Mm-hmm. All right. Somebody says, can you touch on LPs versus LLCs and the current trend away from LPs? Yeah. So Jason, used to be LLCs didn't come around until the 70s. They weren't universally accepted until I think it was 2003 by all states. And we didn't really have uniformity in the courts. So I used to use LPs. When I first got into this business, it was LPs because we knew exactly how they were treated. An LP has two types of partners, a limited partner who has no control and a general partner who has control. So it's still worthwhile doing if you want to make sure somebody does not have any control. There's no reason to put that restriction in place unless you have a reason. So we tend to go with LLCs where we have managers and members. And then even then, 95% of the time, I'm a manager-managed LLC where I keep my management separate from my membership. So a lot of members really have nothing to do with the business, and that's pretty much the same as an LP. So we're able to accomplish with one entity what used to take two or three. So that's why everybody uses LLCs. They're not recognized by the IRS. The IRS says, you tell us how you want it to be taxed. An LP is really for state law. And unless we have a compelling reason to use it, we don't. Just because everybody's getting used to working with LLCs. It's like a Swiss Army knife. So your LP is a spoon, and the LLC is a Swiss Army knife that has a spoon feature. So unless you really need a big spoon, you're always going to use the one that has the knife and the screwdriver too. That's a horrible analogy, but I'm making it. Hope that makes sense. And oh, wow. Somebody says, I'm just going to answer a quick question. Somebody did this in all caps, so I actually read it. Could you clarify an accountable plan also includes corporate directors not taking a salary? Technically, officers are considered employees by virtue of just being around. Directors are presumed to be employees. So yeah, you can do an accountable plan with the director, and just as long as you're spelling out what they're doing. So yeah, you can have one. Make it easy for you. I have a 401k with my current employer, and I'm also leaving the job in the next few months. My family also have a recently formed C-corp. I'd like to ask if I could somehow roll my 401k to fund our C-corp, so that I don't have to pay the hefty tax penalty if I simply withdraw the money. We intend to use the C-corp in both trading and real estate activities. You want to play with that one?
This sounds like Rob's potential.
Yeah, so here's the deal. You're leaving a job with the 401k, with the current 401k sponsor. They're not going to let you just take over your own 401k on their plan. So you're going to have to set up your own plan first off if you want to avoid tax. You can do this in two ways. You can either have your parents establish 401k and you become an employee of it and roll it over, or you do an IRA and you roll the 401k into the IRA. Either one will work. Now, if you want to use it in a C-corp, you do what's called a Rob's transaction. My partner Clint likes to do these. He's the only one here that will touch them. What it is you set up a company, C-corp, and then you buy the shares with the qualified plan. We're using a 401k, but you can actually use an IRA.
So you need to establish the corporation first, then establish a 401k plan.
Roll your money into the
401k plan.
And then the initial issue of stock is going to be partially to the 401k.
Correct.
And then you could be the other shareholder.
Right.
That's it.
That's
and
Rob's.
that's Rob's, and rollover something.
Rollover business startup.
Yeah, rollover business startup. That's what Rob stands for. And anyway, I hope that makes sense. You can do it, yes. And I would do it with Clint Coons, my partner, because he loves those. And don't fall for all the internet junk out there. You want to make sure you have somebody. The IRS gave us precise rules to follow. So it's not like anybody out there knows anything more than anybody else. The IRS says, here's how you do it, and that's how you do it. All right. Can my C-corp reimburse me for my health insurance premiums and long-term care health? Real easy, yes. Long-term health care premiums would be long-term care. And as long as it's qualified long-term care, so not replacement of income, but it's for, activities of daily living. Like if you have 2 out of 7 activities of daily living, washing, being able to bathe or clothe yourself, cooking, cleaning, all those stuff. If you need help with that, then yes, the premiums are 100% tax deductible. Can C-corp pay salaries after close of tax year to be included in that current year? No. In essence, could a C-corp with the tax year ends September 30th pay salary in December that would be deducted in its current tax year? No.
No, it would be deductible in the corporations. That's kind of backwards of what you want to happen, because you're creating an expense in the next year for the corporation, but creating income for yourself in the current corporation.
Yep.
Or current year, sorry.
Other than the usual tax deductions, is there any other big spending items for a C-corp that is tax deductible or tax deferrable? Jenny, that's a crazy question. You got a whole bunch of tax deductions, and then are there other big spending items for a C-corp? Well, you get your 179 deduction, you get your bonus depreciation, but realistically, the secret sauce of a C-corp is that it can reimburse all your medical, dental, and vision expenses 100%, as long as you don't have a bunch of employees rolling around out there. And it has a 21% tax bracket. So if you end up with a bunch of income in the C-corp, it may be better than having it land on you, especially if you're in 37% tax bracket or have state income taxes too. We have clients right now that are in the 50% tax bracket, and I'd rather it be at the 21.
Right.
So we find a way to get it in there. Can C-corp pay salaries? Oh, somebody already asked that. For brokerage investment account opened with personal property trust, how can I use the EIN in my LLC? Well, somebody already asked that too. So it's different person, different version. What is the role of the LLC? It's just a beneficiary of a personal property trust. And you use the EIN so that when the brokerage house issues its 1099-B, it's to the LLC.
Right.
That's all we're doing it for. For a 501c3 nonprofit org, love them. Can one person's name be listed in multiple roles, president, secretary, and treasurer? The answer is yes, and we're going to look at the state as to whether you can have a one-person director. So, for example, Texas requires 3 people to be directors, and Nevada requires 1. So if you're just one person, then you may want to look at jurisdictions that allow that. If you have other people that you're involved with, then you can go to other states. And yeah, one person can be the president, secretary, and treasurer. They're run by their boards. There's no shareholders. So you usually, if there's going to be a restriction, it's going to be that there's multiple board members. By the way, we do that for our nonprofit clients. We offer to be an outside director. So if you need directors, I can give you 2 a year, $1,500, nothing like it, because we love nonprofits and we work with about 3,000 of them. So, in the event your C-corp made 0 profits due to inactivity in any year, but accrued significant expenses, are you eligible for any tax benefits? You carry forward the tax losses. Actually, I'm hogging this.
There are really no benefits to, other than, like you said, carrying forward losses and all. IRS isn't going to rebate or refund you anything.
1244 is our friend. The only way you're going to get a personal benefit is eventually you kill the corporation and you write off the losses personally. You can write that off only for C corps, $50,000 per person up to $100,000 per family.
Yeah, 50
Yeah.
single, 100 million.
So if you have losses in a C-corp, sometimes we say it's time to kill it. And you're like, no, I don't want to kill it. But you're like, hey, there's $60,000 of losses in this married couple.
Right.
You guys are in a high income bracket. Let's take the money now. We'll take it as a loss. Anyway.
Something else that comes up, my entity, my C corp, my S corp didn't do any business this year. Do I have to file a return? Yes. C corps and S corps have to file a return every year they're in existence.
Yep. Now, there's not a lot of penalties if you don't know.
No,
but technically you can get slapped for not filing a zero return. So you always file a zero return no matter what. Even if you lose money, you file it. And that 1244 is against your active income. Just so you know, you write off. We had a client where the accountant refused to do it. It was 60 some odd $1,000. It was a high income client. We did it knowing that it was going to trigger the audit. There were at least what they call a correspondence audit, where they send you a letter saying, hey, please explain this. We explained it and they said no problem. It ended up being a 30 some odd $1,000 tax benefit to them. And took us all of about 5 minutes. Let's see. I have an LLC that owned and sold one property and holds the note with others for wages. Are there any payroll taxes due? So, oh boy, owned and sold one property. It depends on what your intent was when you bought it, but I would say no. If you flipped that thing and you intended to flip it, then you'd have what are called self-employment taxes, not payroll. But holding a note, that's interest that's not subject to old age, death, and survivors, and selling a capital asset, technically, even if it's short term, as long as you weren't intending to flip it, would not be subject to old age, death, and survivors, or Medicaid, which is also known as, or Medicare, known as self-employment taxes. So don't worry about it. I have two separate unrelated businesses. One has full-time employees. The other has no employees. Can I have a solo 401k? Off the cuff, no. If you own them both. If you have greater than 50% ownership, commonality of 2 and 6, even if it's brother, sister, corps, there's all these little things where they wrap them in together, then the answer would be you cannot do it. If it's completely unrelated business, then you may be able to find somebody who would say yes, but if they would have to be completely separate lines of businesses, and then there might be a way. So the answer is off the cuff, no, but depending on whether they are completely different business classes, you might be able to. But we'd want to make sure that we're not inviting the IRS into the tent, if you know what I'm speaking. So we may want to restructure ownership a little if there's spouses or anything else going on. I'm 59 and a half years old and have a Roth IRA that is past the 5-year wait period. I also have a traditional IRA with another advisor. If I convert my traditional IRA to a Roth IRA, will I have a new 5-year wait period on the newly converted funds?
And the answer to that is no. The 5-year period starts with your first contribution to the Roth.
Yeah. So I think they're rolling it into the existing Roth IRA.
Right. So you don't ever restart that clock.
Yep. See, it's good to have Jeff around here. He kicks butt. Jeff, honestly, I was like blanking on that one. I was like, I know there's a rule out there, but my brain has got cobwebs when it comes to some of the conversions. I was going to, I don't know. That's really cool. I forgot all about that because somebody used to always say why you have a Roth IRA, you don't get rid of it. It's because you don't want to restart your 5-year period.
Yeah, that's exactly right.
Yeah, shoot, I totally blanked on that one. I'm pretty new to real estate investing, and I'm a bit nervous with tax season coming up. I currently have 2 C-corps, but I have not had any activity yet, so no flips, no money to use to help with all the expenses. Is it hurtful or harmful in the long run to claim a loss this year? You're fine claiming a loss. That's why we have Amazon. They did it for a decade. Any benefit to doing so? You're carrying forward your losses and you're capturing them. And more importantly, if you have startup expenses, we have to capture them in the first year. Otherwise, they are added to your basis, which may not sound like much, but it's a pain in the butt if you try to get the money out. I purchased an LLC for a single family home that I have been renting for the last 10 months or 11 months. No, that's perfect. the only name is on the proper title is this LLC. Only my name is on the LLC. Should I look at addressing the lease option? I'm not sure I'm following her question. We'd have to take a look at it. But you're fine. First off, you can go ahead and grab your losses in the corp. If you have profit in the single family resident that's in a LLC, we may want to pay some of that to the corp to offset the loss. Okay. I have not closed our first real estate deal yet as an S corp. How should I file our taxes? You're going to grab all your expenses that you possibly can, and you're going to file an 1120S with those losses. It's going to flow down to your personal return and more than likely offset your personal taxes, assuming you have basis. Here's one. Toby mentioned conservation easements. I'll have to send you those, Aziz. I'll absolutely do that. There's 2 that I've dealt with that seem pretty much on the up and up. There's lots out there if you want to just go look around, but there's my clients tell me, hey, they've had good success with a couple of these guys, and they've been doing it for years. So I don't want to give you any flighty ones. Deductibility of prepaid legal expenses. Sounds like an insurance. You're going to be able to write it off. If it's in a business. If it's personal, I don't think you're going to get to write that off anymore because there's no longer miscellaneous itemized deductions. Right. So if it's for a business, yes. If it's you, no. Any difference between my LLC that holds rental property for my realtor S corp? Any difference between my LLC that holds rental property or my S corp and or C corp? I see what you're saying. Yes. Make sure that your S corp or C corp is paying the prepaid legal expense. There, easy. Is the $35 a month fee to Anderson Advisors for platinum membership? Is it tax deductible? To a business, it is. It can reimburse you for it too. How about deductibility of the upfront cost? Deductible. Can the initial upfront cost be paid partially by my LLC and partially by my C corp? Yes.
I'd rather you didn't do that, but yes, you can.
Yeah, do the C corp. Can it be paid in both December and January so as to split any deduction over 2 years? Well, you're a cash-based taxpayer. It's when you pay it.
Right.
So, yeah, anyway, that's all crazy stuff. Somebody's talking about platinum. Let's see. Can the benefits be passed down? That's not really what we want to go over here. Can you provide the top 3 deductions that have been eliminated for 2018 with the exception of the SALT limitation? So the deductions that have been eliminated that stink the worst, exclusions.
Yes.
Meaning
personal exemptions.
Personal exemptions, yeah. Miscellaneous itemized deductions,
yep.
And entertainment expenses are gone.
Right.
So you're no longer able to tax deductibly entertain yourself. I have health insurance through Cobra. Can I have my new C corp set up either as an HRA, HSA, or something similar? Pros and cons. Health reimbursement is all you need, and it can reimburse you anything you pay to your Cobra. And then, Stacy, I would recommend that you really look at doing. I'm not just saying faith-based, but they have some plans where I don't know how faith-based they are, but MetaShare and some of these others, they're significantly cheaper than Cobra. Everybody I've looked at. Quite literally, it's about a 50% shaving, and you couple them with there's a faith-based plan or the MetaShare plan, and then they have a high deductible plan that so that it covers everything. But you may want to look at that, and you're going to save yourself a lot of money. And if you need somebody, I have a fiduciary that does that type of work. I don't do it. Here's a long one. If a real estate sales business is not getting enough sales and rental properties are losing every year, will they define my real estate business as a hobby?
No.
Yeah. So as long as you're trying to make a profit, you're good. There's this thing. Rental properties, you can lose money all the time. It's an active business, and it says in the event of a person or an S corp in a business for profit, if they don't make money 3 out of 5 years, then there's a presumption that they're a hobby, but it's a rebuttable presumption, and you show that you're trying to make a profit.
Yeah, there's a whole list of what makes a business a hobby, and that's just one of the rules of thumb.
Yeah, and get this. There was a guy who had 23 years of losses as an individual, and he won.
Yeah, I mean, what they're really aiming at if you read all of these exceptions or what causes it.
Mm-hmm.
Are you really trying to make a profit or not?
Yep. All right. I am starting a holistic assisted living care facility in the foothills of the Blue Ridge Mountains to stop and reverse Alzheimer's using latest science-based health protocols. I'll be operating under a private membership association similar to Boys and Girls Scouts of America and a bunch of others. Generally allow all our own rules and public law. Since a PMA is not a public entity or a public collective entity of any kind whatsoever created by or under any government authority. Oh, yeah. There's a bunch of stuff. What taxes would it pay? If it will be operating as an unincorporated entity, would it not be exempt? What forms would I fill out? So, Jim, if you're opening up a non-religious organization and if you're helping people reverse Alzheimer's or you're doing any of those activity, that would be 501c3.
You have to file for exemption.
You have to file for the exemption. It's a 1023 application. You need to set up a corporation in the state where it's operating. It would be exempt from state, federal, and local property taxes more than likely, but you have to apply for each of those.
Right.
You will more than likely be granted if it's actually operating. So I'm just telling you, I would actually jump through the hoops. The only type of organization that does not have to do all the hoops is a church. And this doesn't sound like a church.
Now, would you keep the real estate out of the exempt organization, or would you leave it in?
It depends. So if I have lots of depreciation to capture and I'm not going to have much, maybe it's kicking me a little bit of loss, I may keep the real estate out and rent it.
Rent it to the holistic agency.
Yeah, and as long as it's arm's length, I can actually get paid and I can actually get money. If I want to give it the rent, then it's treated as a contribution. Every one of my rent payments is treated as a gift. So I could still keep it outside so that if a slip and fall happens, it doesn't go inside my 501c3. It doesn't. Right. Yeah. So I have my own S-corp business. Can I deduct my own children's college tuition as professional development cost? Lan, your depends. Technically, the way I hear it is probably not, unless they're doing something that is helping them in your business. Otherwise, you just pay them and let them pay their own tuition. So I have kids basically paying their own tuition at their own tax bracket. We already know we can pay them $12,000 a year, not pay any tax other than payroll tax. So it's still a really good deal. So pay your kids. And while you're paying your kids, have them start a Roth IRA so that they never pay tax on that ever again. They don't pay tax the first time. They don't pay tax when they take it out. And do that. We already answered this one. This is the last one of these guys. And then we're jumping into all the live ones. I just turned 70 and must begin taking RMDs from a couple IRAs next year. Do I also need to take RMDs from our qualified retirement plan? Yes. And somebody just said, pay the kids more and let them take the tuition credits. Yes. See, you guys are good. You guys are thinking about this. And there's a bunch of people chiming in. I love that. All right, now let's start jumping into these. Can you use a Rob C-corp to operate as a realtor? Jeff, you've been patient. The answer is yes. So if you do a Rob's transaction, you can do anything. Now, here's the one catch. Your realtor association may not let you operate as a C-corp. So it always depends on the state and whether or not they'll let you do it. As a broker, chances are they probably wouldn't care. As a real estate agent, they probably do. Can you claim medical expenses already paid with flex spending funds?
No, because those are pre-tax. So
yeah, so the rule is always, did I pay tax on the money that was spent, and then I can get it back. How much does it typically cost to start a new S corporation in Illinois? That's up to, depending on what type of organization it is. I would actually talk to somebody here. If it's just plain vanilla, they're not horribly expensive. If it's a Rob's transaction, they get crazy. Do you do Puerto Rico tax returns? If not, do you referral? You guys doing Puerto Rico?
We can do all the territorials. They use the same forms as the IRS does.
It's like a 4% tax down there, right? I'm going to live there for 183 days, and somehow I magically don't pay much. It's crazy. This guy's flying in there for 1 minute. That's a day. I know. I love saying stuff. Yeah. Is there any advantage to bundling charity giving in 1 year for personal filing? Yes, that's exactly what you do. There is a huge benefit depending on how much you give and whether or not you're above your threshold. If you are itemizing no matter what, it doesn't really matter that much. But if you are really close to that $24,000 limit, then in like you're really close, like you only get like your charitable deductions are pushing you up over, but you're missing a lot of them, then I'm going to tell you to do 2 or 3 years at a pop. You do not donate money out of a C-corp because it's limited to 10% of its net income.
Correct.
I am selling an investment house that I own with a partner 50-50. Do we have to break the partnership before doing a 1031 exchange? You have to go house to house. So if you're selling a house, you technically have to take it in the same names that you own the house in. The only exception that I know of is I believe that you could perhaps break it into tenants in common, in which case I'm not sure whether they would have you break, like whether you could exchange your tenant in common, because most of the buyers are going to say, I'm not going to play that game. I just want to buy the dang property. Otherwise, you guys buy the property and you do what's called a swap and drop, where you agree to buy out, you buy the new property, and then you buy off their interest either through a payout or there's some methodology.
Yeah, there's a section, I want to say it's 721, but where you're actually swapping your property for an interest in a real estate partnership or something like that.
Yep. It gets kind of, in other words, here's the easy answer to make it easy for me and easy for you. You need to have a qualified intermediary that really understands, and they can advise you because they're the ones who have to put their name on the transaction.
And that's what I tell clients when they first start talking about 1031. First question I ask is, do you have a qualified intermediary?
Yep.
Because you need to talk to them and they can answer a lot of your questions.
All right. I want to make sure I understand about the deductibility of broker fees. I create an LLC which holds the account. I create a C-corp which is a member of the LLC. The LLC pays a guaranteed payment to the C-corp. The C-corp pays the brokerage fees. Is this correct? Yes. How is this the C-corp's expense? Well, the C-corp is just writing off the fees to the broker as an ordinary and necessary business expense for its management entity. It's receiving the payment as a guaranteed payment to partner, and that causes the flow through to be a net amount that goes to the individuals via the K-1s off of the LLC. So the LLC is a partnership. So for federal tax purposes, we're talking about a partnership and a corporation. The corporation's receiving guaranteed payments from that LLC as a partner managing the LLC. You're allowed to do that. And instead of flowing onto your Schedule A, it's netting out the amount that flows onto your tax return. So whatever amount goes onto your Schedule D is the amount that you pay tax on. We're just making sure that we're getting it before it goes to your Schedule D. If you let it go to your Schedule D and then you try to write off the management fees, that involves your Schedule A, and you will not get to write that off. So that's why we do what we do. All right. Can you offset holding expenses, preparation for rental expense on 5 properties against income received for flipping and 2 other properties? Wow. So the flipping sounds like you have profit. I'm not sure I'm following that question. Maybe I'm misreading.
Yeah, I'm not sure that I would want all of those in the same entity anyway.
Yeah. Well, you wouldn't want it in the same entity. I'm just thinking of you'd want to make sure that they're separated out. Your rental properties you don't combine with your flipping. But it's all going to flow down. Depends on how it's taxed. If it's an S-corp, it's all flowing under your return anyway. And will your real estate losses, could they offset? The answer is yes, if you're a real estate professional, if you're actively participating and you meet the income thresholds, or if they just offset each other. So we'd need a little bit more information, Ina. I would actually email us in. My wife works as an independent contractor. Can we have wages paid to our C-corp or LLC? Actually, yeah. It just depends. You want to make sure it's in your state, or it depends on the type of work they're doing, and you make sure there's no licensing issue. So if they're professional, they may be required to be an S-corp or an LLC that's ignorant. Anyway, I'm talking too fast. Or you make it an LLC that's taxed as either disregarded or as an S-corp. All right. Is Anderson offering any tax package specials right now?
We're kind of revamping our pricing right now.
We are so busy right now.
Yeah.
But that said, if you want to become a client, you're going to be talking in January for your initial consult, because right now we are till the end of the year just too jammed. They do have a $2,500 investor package you can talk to them about that has a lot of units and a lot of benefits that goes along with it. And that'll make sense when you're saying, why are you guys so busy at the end of the year? It's because we're trying to get with everybody and save them money before the end of the year. Do you have to have an entity to get the 20% deduction?
No.
Yeah, so the answer is no, what Jeff says. We set up a QRP for a new psych practice that flows to our corp. I'm not taking any pay this year, only reimbursement. In order to make a contribution to the QRP, I believe I need to do it via payroll. What is the time limit for getting this done? End of the calendar year. So end of the calendar year to make a deferral. So if you have a 401k, then in order to make a tax deferral, you have to do it before the end of the year. And it has to go directly into the 401k through payroll. You can still make contributions after the year end from that the company matches, but it's also based off of your income. So if you have no income, it can't do a match. But if it pays you before the end of the year, 20 grand, you could either defer the whole thing pretty much, or you have the ability to put 25% of that. So let's say you paid yourself 20 grand, you took it all because you needed the money. The company could make a $5,000 deduction next year. You could still do an IRA. If I use bigger numbers, those numbers go up. If it paid you $100,000 before the end of the year, it could make a $25,000 deduction next year up until when it files its tax return. So it's when it actually files the tax return. What if one of the lower boxes is the development company or the management company? Should be outside the holding company. Oh, that was back when we were talking about the entities flowing around. I wouldn't have one of the lower boxes be the management company. Actually, it could be and flow back up. So hopefully they're still listening, John. Most of you guys are still on. It's like 97% of you guys are still on. You guys are troopers because it's 4:30. But I told you we'd get through these. If we have 4 LLCs under Wyoming Holding LLC, we purchase property under one LLC. However, we want to dissolve 3 and the holding. Is that possible? Yes. So if you just want to have one entity holding the real estate, you can certainly do that. I thought that revocable trust was how you transferred your assets at death without probate. That is true. And then can the trust elect to distribute the capital gains to the beneficiaries? Yes. We're talking about the revocable trust. So revocable trust becomes irrevocable when you pass, and then everything goes to the beneficiaries. If it's distributing to the beneficiaries, they pay tax. So here's how it works. Jeff passes away. Sorry, Jeff, I'm killing you off. He passes away in September. Let's say he passed away on September 1st, and then we distribute on January 1st. So there was 3 months of income. Mm-hmm. If as long as that's distributed to the beneficiaries, they pay tax on that income. That's all that it means. So usually you don't distribute the next day. What is the best entity for flipping properties? An S or a C-corp, or an LLC taxed as an S or a C-corp? Can you sell the house and take the residence exclusion? I think they're referring to the issue we had earlier. The answer is yes. That's how you do it. You use your 121 exclusion, and way to think. We have 2 Wyoming LLCs and live in Florida. We are attempting to set up a checking account for LLCs. However, our bank says the LLCs have to be listed. Oh, you're trying to open them up in Tom and Barbara. You're trying to open them up in Florida. You need to open up the bank accounts either online, register and use the Wyoming address, or you're gonna have to let them know that it's a Wyoming entity. Any Florida bank is going to make you register it in Florida. And yes, it negates the purpose. So if you need somebody to contact your rep here, and they'll put you in touch with the banks that we use. Anderson set us up with a revocable living trust. Summarize the specific steps the beneficiaries need to take to get the assets after the grantors assume room temperature. Oh, after they pass away. Kevin. All right. So, yeah, Kevin, you're the trustee during your lifetime, which means you hold legal title to everything on behalf of the trust. When you pass, they become their successor trustees. They would step into the shoes of you. They would put themselves on the accounts, and literally, if it's cash, they just give it to themselves, or they follow the trust agreement. So I use my dad as an example. When he passed away, everything was already set up with my mom on all the accounts as a co-trustee, so that we didn't have to do anything. The only thing that was tough there was the pension that my dad had, and she had to contact them as the beneficiary. Need to be careful with this in terms of divorce. Grantors have been forced out of their home. Oh, we were talking about the house and making sure that you cover it. Wow, I'm really behind here. Here we go. Let's see. How was I mentioning here? I'm also a platinum member, so maybe it would be better to submit it through the portal. Yes, Casey Buckland. So I'm going to write this down here real quick. Casey, sorry. Make sure that I take a look at his question. If he thinks it wasn't answered, it may have been last week. Who knows? Probably was gotten to at some point. How do I transfer funds from unsecured credit from LLC to LLC1 to fund real estate, where LLC1 will hold the asset? How do I transfer funds from unsecured credit? Oh, I see what you're saying, to fund real estate. So basically, Ruben, if you have an LLC that has unsecured credit and you own it, you could borrow that money, take it out, put it in another LLC just as easy. You may want to loan it to the other LLC. I don't think if it's just you're not going to end up paying yourself interest on that, because it would be an expense and income of the same amount, so it would wash. If our rental LLCs do not have enough to pay some expenses, can the C-corp pay these expenses? If it's the management entity, yes, and then you would be entitled to be reimbursed. Merry Christmas and Happy New Year's, guys. Thanks for all you do. Thank you, Bill. Really appreciate it. Sadly, this is another one. Parents recently passed. I'm very sorry to hear that. That's always rough. They had a living trust and owned several rental properties. One will be transferred to me, whatever their term is. My brother currently manages the properties, but very poorly. Will I be responsible for the taxes on the property, and can I take over the rental altogether? If Eli, if it's in the living trust and you're a beneficiary, then I would be making sure that you're in contact with your brother, and you may want to swap them out. You probably have the right to remove the trustee as long as you appoint another. You'd want to see the documents. So if you are not happy with the way a trustee's actions are, it doesn't mean that you can go in there and assume the role yourself, but usually you could move to remove the trustee and have a professional trustee assume the position. This one says, Anderson formed a Nevada C-corp with a March year end. Okay. I have a Nevada LLC as the checkbook for the C-corp with a December year end. I also have a Minnesota LLC for rental property with the December year end. For the C-corp, do I report income expenses for LLCs with December year ends, or just slide them with the June? Well, so Steve, basically what he has is a couple of LLCs and a C-corp that's managing.
Right.
If the LLCs move the expense to the C-corp, regardless of whether the C-corp does anything with it, it's out of this tax year. It's no longer going to be in 2018. As long as the C-corp pays that expense at some point before its tax year, you're going to have zero income showing up on anybody's return. I hope that makes sense. If you already paid the expense, or if the C-corp already paid the expense, then it's getting reimbursed. The most important thing is that to get it out of a tax year, you actually have to pay that expense from the entities whose tax year it is. So if it's one of the LLCs, December year end, the LLCs have to pay that C-corp before year end. Otherwise, you don't get to write it off for 2018. Or, so I hope that makes sense. Are regular business expenses deductible to an LLC taxed as a pass-through entity? It depends on the business, and it depends on what's going on inside it. The LLC won't make any difference if it's a pass-through. It's going to be dependent on the recipient. What is the best way to get precious metal holdings into an OJ retirement plan? Meaning, what entity is needed? You guys you're killing me.
I'm going to say self-directed IRA, self-directed 401k, primarily because banks hate hard assets.
Yeah. Well, I'll tell you this. So I'm going to change it one bit on a legal
fine.
standpoint. An IRA is still subject to state law, then come get it. In OJ's case, he was a beneficiary under the NFL Players Union pension, which is an ERISA plan. So they can't take the distribution. I can take the distribution from an IRA. That's the only difference between those two. So if OJ had an IRA, then the Goldmans could step in and take his distributions. They cannot touch his distributions out of the NFL players' pension. So how do you get precious metals into a 401k? You have to have another employee participant, and it needs to be a 401k. Then it would qualify as ERISA. And even if to get another employee, you could literally just give somebody $500 into an IRA and say, roll that into the 401k if you don't want to have them as an employee. So you just want it to be a multi-employee. Yeah. So all receiving an employment settlement under an unlawful discrimination claim. Congratulations. On the new 1040, if I include these fees, where do I get to present it on the 1040 form? If I can convince my employer, which is very likely, you get the 20%. So here's the deal. So if you have an employment claim, you're not going to get to do the 20% 199A deduction period because you're an employee. Anytime you have unlawful discrimination, it's pretty much going to be W-2. And if you have lawyers, egads, I don't know how the miscellaneous itemized deductions affect that. I think you're going to get the net, but this would really stink. You're going to have to make sure your settlement is specifying whether this is a return of wages, whether you're recovering back wages, or whether or not this is pain and suffering or something else. You are going to want to talk to your attorneys about this like yesterday to make sure that they're addressing the taxes on it.
And the attorney's fees themselves are kind of a big deal as how they're reported.
Yes.
Whether they're reported as part of your return or your settlement. And so if you get $100,000, but 40 of that goes to the attorney, you don't want to pay tax on $100,000.
Yep. All right. I am a W-2. So I hope that helped you. Can more than one room of your home be used for corporate tax expense? My wife uses our study for business, and I conduct work in our master bedroom. So can we claim both? The answer is yes, you can, but it has to be exclusive. So your master bedroom, you better make sure that the portion that you're using for your business, in other words, it's not the bed, the portion that you use for business is the only portion that you're counting.
Yeah, if it's a master bedroom, it's going to be a very small portion.
Right. Now, I have seen bedrooms qualify. They actually have, but you put files on the bed and you take pictures of it. But here you're using that bed for something else. So that square footage would not work. But you could still take a portion of your master bedroom. It must be a huge bedroom. Somebody said, what about New Jersey? New Jersey has both an inheritance and an estate tax. So that's, I think, what they're referring to. If my C-corp incorporated in 2017, do I need to file now before January 2019? So incorporated at the very end of 2017, it depends on your year end. Chances are you have a return due.
I'm guessing you probably have a September year end for 2018.
Which would be due 12/15.
1/15 now.
1/15 now. Oh, sorry.
Because they changed the dates.
Yeah. Right. So you have one due in January.
Which can be extended. So.
Yeah. And then, you get a 6-month extension. God bless it. My little brain, sometimes too many numbers. Should I request an extension on my personal taxes until my nonprofit has been officially recognized? We made a significant contribution. So the answer is I would request an extension. It's better to have the exemption approved. It doesn't mean you won't get it, but it may get kicked out. And it won't be if you're not filing the return. So I would file an extension. Do you advise relating to SALT deduction workarounds using the charitable deduction credit? You don't get to do that. They already got rid of that in the regs. So that was a bunch of states being dumb.
But one thing you can do is if you're reimbursing for home office, you're transferring some of your real estate taxes into the home office.
Yeah. So John, you're not going to get a workaround with the charitable deduction credit, but what you will do, and no, they will not win that. I would give that about the same chance as Buster Douglas had against Mike Tyson. Whoops. Right. No, I just watched that fight again. 1990. Can you believe that Buster won? So I'm going to say that I give it about the same chance, which means they have a puncher's chance. But one law professor wrote that they must have written it in crayon, the states, because it made about that much sense. Yeah, they're not going to get it as a charitable deduction. In Oregon, does home property tax cap mean that if a property tax is $4K, we'll still be able to deduct it? What does the cap mean? Home property, the cap means that you're limited to the amount that you can deduct on your personal return for all state and local taxes. The other cap that's used is when you have property tax caps, it's that it can't go up more than a fixed percentage on an annual basis. So in highly appreciating places, they don't completely hose you. I hope that makes sense. All right. My wife, as a realtor, has a single person LLC. Is there any benefit to having her LLC assigned to a Nevada C-corp? No. But you could, Steve, have a management agreement to allow the Nevada C-corp to manage her. What I would probably say is, I'm thinking about the ABA and what they say on this, American Bar Association. They talk about, for professionals, any licensing, it's better to use marketing fee agreements. So to have the C-corp do all of her marketing and social media and stuff like that. That way they can't mess around with it. But I may want to look at her being taxed as a S-corp because chances are she's going to reduce her self-employment tax. And it's usually pretty significant. It's usually a $6,000, $7,000, $8,000 savings as a minimum. And then you also get the accountable plan as a result. So there's a huge benefit. There we are again. Can't get through a single one of these without talking about it. I'm now a contractor attorney with no benefits. Should I create a corporation? Which one to pay for benefits to reduce taxes and pay for benefits? So I recognize this name, and if you're an attorney and you're in California, you have some other hoops to jump through. They don't let you, I don't think they let you actually be, I'm trying to remember if they don't let you be they don't let you be an LLC, I think. I think they let you.
I know doctors aren't allowed to have corporations.
Yeah, the Bar Association has some funky stuff, and I always get mixed up on it. I just did one too, and I just can't remember off the top of my head. So the way that you do it is either you have your practice, you as an individual with the sole proprietorship, and you have it's going to sound weird, but then you have a C-corp set up that you pay money to, or an S-corp that you pay money to for everything that's not legal. And then you pay a little bit of self-employment tax, and you have an entity that probably is handling all your reimbursements and benefits. But it's always a question we can have. There is a way to be an entity. It depends on the state that you're licensed in and where you're practicing. So I'm always going to say, yes, you want a corporation in your life, because that makes life so much easier to have an accountable plan where we don't have to report stuff and it looks plain vanilla. And just to give you guys an idea, S-corps are audited 0.3% of the time versus individual sole proprietors that are making 100,000 to 200,000 is 2.2, was 2.4. But so you're talking about a 700% increase in likelihood to be audited if you're a sole proprietor, and they lose 94% of the time versus about 67% of the time of an S or a C corp. So it's not even close. From a tax standpoint, I would say, hey, 1/7, or actually it's more than that. It's less. It's quite literally like 1/8. Mm-hmm. So I'm looking to start a business. Don't know whether to do a profit or nonprofit. Doing research, nonprofit would be best. It would depend on what your new business is. I like nonprofits, but remember, the benefits cannot inure to you as the shareholder. Wow, there's still some questions here. Another, please. My wife has a C corp that is chosen to file as an S corp, which means they made an S election, so she has an S corp. This S corp pays a very nominal amount as a 1099 to my mom, who now files her own return under the new tax law, since there's no point claiming more dependents under our joint return. Of course, I'm receiving some nominal income splitting. Should I make my mom a shareholder? No. For what you're doing, it's probably fine. And chances are you want an accountant to get some eyeballs on that. So it sounds like he's paying mom to do some income splitting. Make sure she's doing some work. But you can also get benefits. Like, the reason that mom is the dependent, it's a good thing, is especially if they're elder, is that you can cover their medical, dental, and vision if you have a C corp. So Jeff, you have some people that it's pretty high expense. What are some of the big ones?
I mean, I see some of these policies that run in tens of thousands of dollars just for a single.
Yep. And they're paying for something that might not be covered. So I know that we had a few clients that were in the 30,000 range of reimbursement just for mom. as long as she's a dependent. But you may not be there yet. So that's why we just look at it, calculate it out, see what's best for you. I will be inheriting a home that will never live in and want to purchase a home in 2019. Do you know if I will still be eligible for the first-time home buyer? Oof. Oh, I'll be inheriting a home that I will not ever live in. You can sell that house. You stepped up in basis, Eli. So the inherited home, you will not pay tax on. And you should still be eligible for the first-time home buyer's credit because you did not buy a house.
It really has to do with what was your principal residence.
Yep. So if you inherited a piece of property and you're just selling it, it's not even going to show up on your return as income.
And sometimes first-time home buyer doesn't mean the first time you bought a home.
Mm-hmm. All right. Somebody else says, how do I become an employee of an LLC that is owned by my husband and I? It has to be a S corp or a C corp, Diana. So we just have to make sure that we classify it. It's as simple as filing a one-page tax form if it's not already taxed as an S or a C corp. Thank you guys. Thank you guys. There's some nice ones. Rolled over an old 401k and 401k Roth to a brokerage account. The brokerage receives it all in one lump and placed it in a traditional IRA. Oh my gosh. Holy crudola. So they mixed up a Roth and a traditional IRA. Doug, I would switch that brokerage. I'm sorry. If they mix this up, I don't agree with them that they can't separate it out. I'd be looking at it.
They definitely need to fix this.
Yeah. Is the 1244 only passive? No, you can offset active. I think I answered that one earlier. Can I transfer money from my personal account to my C-corp to pay for a business credit card? Yes. And you can do it whenever you want. It's just part of you're either loaning it money, Julia, or you're contributing it. And either way, it's not taxable to you. Does an S corp have a $200 per month penalty for not filing?
It is $195 per month per partner or S corp shareholder.
Yep. So don't be late.
Up to 12 months. So it's expensive.
If you mess up your first year, they'll give you a pass. But after that, it's.
Yeah, once they've decided that you've misbehaved in the past, they're not so forgiving.
Wow, so here's a cool one. I'm a government attorney, W-2 income. My wife is an attorney, consultant, and real estate agent, and providing services as a sole proprietor with income under $100,000. We have a corp set up that manages LLCs for investments. I also set up an eBay business. What's the most advantageous entity structure to minimize tax and increase retirement? We also have a solo 401k. I love it. I would probably be looking at getting the attorney, consultant, and real estate agent probably are going to have to be in their own separate boxes for licensing purposes. And I'd probably have those as S corps, and then I'd have a management entity doing your eBay as a C corp and seeing whether it's going to pencil out. So without getting into too much structure here, chances are you're not benefiting yourself. Even with the income under 100,000, that's still self-employment tax of 14.1%. So we could at least get that down to the $4,000 or $5,000 mark, if not even farther. So we could probably save 10 grand just on the self-employment tax. See? And if you already have a 401k, that's awesome. Like you could probably not have much tax. How can I mitigate? I don't want that flowing up there. Let's see. How can I mitigate cash out received from a home in my name? Put in 401k and then take a loan out on that. I do not have a large C corp. Oh, so if you want to, hey, if I have money that I'm getting out of my house, chances are if you're just getting the money out of your house, you're not going to get to write off its interest, because right now the only type of deduction you get on mortgage is if it is acquisition indebtedness. Of course, if you're not going to itemize, it's a moot point. You could put that into a 401k and take a deduction on it.
Yeah, so if it's not for acquisition or improvement, then you may have other issues.
Yeah, so we'd have to, I wish I could give you a simple answer on that. There's a couple moving pieces. What you want to do is see whether or not you're actually losing a deduction or whether you're under the standard deduction, and then what's the amount of deduction you're going to get if you put it into a retirement plan. It could be that it saves you, a few $1,000 and you say, yeah, I want to do that. Is it better to create C-corp or S-corp when you're new, fixed, and flip? It's always going to be, that's a loaded question. It depends. It's on facts and circumstances. I'm always going to look at your income and how much money is being made. You can always take a C and make an S, but if you make an S and then go back to C, you have a 5-year waiting period before you can go back. So I tend to start with the C and stick there until I need an S. If I have my daughters each do some online research and pay them $5.99 or less, do I need to 1099 them?
You do not need to 1099 them if it's under $600.
Yep. I own a rental house, 50-50 with my brother, and had the gutters replaced. Paid the contractor, a sole proprietor, and he said his accountant would send me his W-9, but she won't, and he won't answer his phone. I'm going to have a property. Am I going to have a problem when I file my return? Not having a W-9, so no 1099 can be issued. It depends on how much you paid him. If it was over $600, the IRS is not too nice about this.
Which is why we preach don't pay anybody that you don't have a W-9 for.
Yeah. Now you're talking to a guy who had 2 contractors denied deduction-wise. We were part of a super audit years ago, and they went through over 700 vendors, and only two of them, didn't have W-9s on, and they made me pay $750, which I did gladly to get them out of my office. But it was annoying because the 2 vendors was a landscape company and a magician. The magician ended up on America's Got Talent and went all the way to the finals. He's still rolling around out there. And the landscape company went out of business. So it was one of those things where to get the W-9 just was a pain. We are currently repairing our rental properties. Can we claim that as losses? If you're repairing, yes. If you're improving, no. So if you're doing like a whole roof, that's added to basis. If you're repairing stuff, like fixing the roof, then you can write it off. The safe harbor is $2,500 per invoice. So make sure that if your contractor's invoicing you, that they don't give you anything above $2,500, and then it's automatically going to be a repair. Do you ever recommend a single member LLC, or is it always a poor choice? It depends. I like single member LLCs, especially for real estate. I don't like it for active businesses unless it's owned by a corporation. Or sometimes if it's a LLC owned by a 401k, disregarded is fine. All right. Do we still have time to hire your services as our tax company? We are platinum members already. End of the year is tough, but again, it depends on how quickly you need. We're not going to be able to get you an accountant before the end of the year, but you can always send something in, and we'll see whether an attorney or somebody else may be able to fit that role, and how much of it we need to do this year versus you could always start off as a client next year. I just know we have a very busy tax practice. I wish I could say that we had tons and tons of people waiting for work, but we're the opposite. We slaughter our people, and we ask a lot of them. Jeff is just looking at me like, "Yep, you're killing us all. We're all turning pink." So I'm going to say, go ahead and contact us, and I'd probably have you go through one of the attorneys first, and then make sure that we're adequately servicing you. We are looking to cancel our employer health insurance. Oh, the fiduciary. Oh, yeah. Email me, Maggie, and I'll get you. It's going to be David McShane is the one who does all the health plans. His company is very good at it. What is meant by non-cash component depreciation regarding LLC? Yeah, that's funny. I'm thinking that you're talking about component depreciation. You're talking about a cost segregation, and you're probably talking about separating out 1250 property from 1245 property, which means in English 27.5 year property versus stuff we can bonus depreciate and take all in 1 year, and you have to separate it out, and it's non-cash, so it's the actual pieces. How do I post? Oh yeah, I answered all these questions. Wow, we're getting close to the end. Somebody has emotional distress. Good, Amir. That means that good. That's good for you. So that's non-taxable. You want to make sure it's all that, and then you don't have to worry about the attorney's fees. All right. Thank you for the tax learning sessions. Merry Christmas. Hey, this is a Joe and David father and son business. You guys, nuns taught you well. All right, you got to go. I have two C-corps, you guys, and two LLC, or I have a C-corp and two LLCs, one LLC attached to a QPERT or QRP. Those are for my tax deed business. Haven't made any money in either business. Let's see, should I link for tax purposes? How will my business actually be done with no money? Sure, I'll just chill out on the LLCs. Chances are they're not going to have to do anything because they're disregarded. The only one we'd have is the C-corp, and you roll over any losses for 20 years. Would you recommend additional after-tax contribution to reach the $55,000 max? Sometimes. It depends, Eva. It's a great point. What they're saying is that I have a $55,000 max on my 401k and profit sharing plan, a solo 401k, for those of you who aren't familiar. I can make an employee deferral of 18.5. And again, if you're older than 50, you can put an extra 6 in there. But the company can match up to 25% and deduct it of my salary. So if I took salary of 60,000, I could defer 18.5, but my employer could match 25,000 or 25% of that into the plan. Now, if it paid me 60,000, the company could, in theory, put in 55,000, but you'd have to have over $111,000, $111,500 to put it in, and it would write off only 25% of the 60. So it would get a $15,000 write-off. I would be deferring 18.5. I would have $55,000 in my plan, which I would pay tax on eventually. So the question is, does that make sense? Only if you're going to do a backdoored Roth IRA, and that one is at TaxWise. Come watch it because it's one of our strategies. Or you can read up about backdoor IRA contributions. We could probably get that whole thing into a Roth since you don't want a deduction. I've maxed out my annual gifting exclusion for the year for one of my children. Do I need to be careful not to give him non-cash gifts at Christmas? No, I wouldn't worry about that. Amazing job. Which retirement plan has 12/31 deadline for contribution? Anything you do. So if you're doing employee deferral, 401k, then you have to make the employee deferral by 12/31 because it has to be through payroll during this year. Everything else can be done after the year end before the return files.
Right. So your IRAs are going to have a deadline of April 15th of the following year. Your qualified retirement plans, the employer portion, is going to be the due date of that return, which could be as late as September 15th, October 15th.
Mm-hmm. Here's a good one. Can you eliminate the tax on the discrimination settlement by designating that the attorney's fees are paid separately by the payor? That's interesting. I don't know the answer to that. I would have to look at it, but my guess is that as long as it wasn't part of your settlement, but you said, hey, you're getting paid, and then you also agree, but they're paying it on your behalf, so I think that you're going to...
I think the court cases have gone both ways on that, primarily depending on what circuit you may be in.
Right. I think that the easiest way is to make sure it's not compensation for past wages. And that way it's not taxable wages to you. Because, again, I think under the miscellaneous itemized deduction elimination, I know it took away all of the accounting fees. I think it probably took that away too. I'd have to read up. I haven't really looked at it. So it'd be something where if you guys want to email that one in, we could do the research on it. And then do we have any more tax Tuesdays for the end of the year? Or is this it?
This is it.
All right. So we're going a little long just because this is the last one of the year. And I'm going to throw something else up there on the screen to go back and if you're click. Here we go. To do the year-end recording, make sure that you watch that. This is going to give you a bunch of ideas to do stuff before the end of the year. Can I buy a primary residence with my 401k loan? Yes. To ensure protection of solo 401k with 1 year, pay them, ask them, enroll. Does that compromise the solo status? I don't think so, as long as you have another contributor. So what she's saying is if I have a solo 401k, but I roll another participant in there, does that void out the solo 401k? I don't believe so, because they're not entitled to make contributions. You're just making them a participant by rolling their IRA into it. So they could even be a non-full-time employee. Makes it easy. But, before we did anything like that, I'd have you talk to somebody who that's all they do. So I'd probably have you talk to one of our financial guys. Let's see, got started as a trader in 2017, but not live trade until late this year without any profits. Have filed for the LP in S-corp. Is the LP return due in March 19th or January 9th? So LP would be due next year and not in January.
So an LP return would be due March 15th.
Yeah, March 15th of 2019. Yep, 2019. Good. She asked a couple questions as long as this is not a residence. Let me grab a couple ones. We're getting to the end here, guys. Where I thought we were. If I make profits as a trader and transfer money from LP to S-corp, do I just withdraw from the S-corp to pay myself? And do I need any specific documentation? Arlene, the reason you'd be doing that, and chances are it's a C-corp, but if it is an S-corp, the reason you're doing that is to get you the reimbursable plan. So you just want to make sure, and if we did the documents, you're good. You just pay yourself back, and then it's an expense to the S-corp and not reportable income to you. I formed an LLC and I flipped it. A few months later, I formed a C corporation to better manage. Should I move the LLC used for the joint venture, wholesale, and flipping to a wholly owned company of the C corp? Pros and cons. Rodney, it really depends on what it is. If you're flipping inside that, I would say yes. Even if it's even if it was a JV, I might kill it if it was a JV LLC. In other words, I don't want to have other members involved. But if you have an interest in it and that's where you do your flips with a partner, your ownership of your portion could always just be in the C corp. Like the LLC could be taxed as a partnership, but the partner could be your C corp instead of you, so it doesn't hit your personal return. Somebody just asked, by the way, I have a C corp tax, or I have an LLC tax as a C corp. My girlfriend lives with me and has no health insurance. If I claim her on my taxes, can my C corp cover her medical expenses? She is also a 10% member, so she's an owner operator. So you could do the medical reimbursement to the two of you guys. You don't even have to cover her. As long as she's involved as an employee of your C corp, you're fine. Otherwise, if she makes money, it might be a little tough of cohabitating adults to make her a dependent of yours. I don't see that happening. So I would just make sure she's participating. If she's already an owner, then chances are, yeah, that one. So I have a large commission, more than $1 million. How do I turn this into passive income?
Congratulations.
Yeah, you have a tax problem, but I don't think it's going to be. Yeah, how are you going to turn that into passive? You're not really, unless you're paying a lot in rent to something out there. But
yeah, because the whole idea of commission is that you did something to earn that commission.
Right. So here's how you do it. If you have a company A is doing activities which generates lots of income, you could have company B doing services for company A, and it could be entitled to a portion of the money. So in your case, you might have the commission going into an S corp, and it would be the distribution out of the S corp would be non-active, so it would be passive to a certain extent. It would just be non-earned income, so it won't be subject to old age, death, and survivors. Company 2 that's doing management, you could pay it, and if it's a C corp, it's just going to be taxed at 21%. If you dump a bunch of money into a retirement plan, obviously, like a cash, if you're making that much money, then a cash balance or a defined benefit might be appropriate, depending on how much we can get in there, a couple $100,000 maybe, depending on your age and whether this is consistent. I have plans where we're putting in over $600,000 a year, so of tax deferred, so we could get a lot of that gone. So like there's still things we could do, and then if that's still bad for you and you're saying, geez, I'm still having to pay tax on it, then you look at a 501c3, maybe set up your own, dump a bunch of money into that with the idea that you're going to do some good with it, and you're spreading out, like you're getting a nice tax benefit now to keep control of that money and give it out over time, or do your charitable activity. So I just gave you a few options. There's something I would reach out and get one of our advisors to walk you through kind of your choices. Somebody says, I absolutely love Tax Tuesdays. Yeah, we do too. My grandmother wants to give undeveloped property to my mother. The property title has my deceased uncle in her name with the signature of the uncle's widow. No, unfortunately, when you have real estate and you have somebody who's a decedent, you're going to actually have to probate that. That just stinks. So unless they are joint tenants with right of survivorship, then you would not need his signature at all. Because if it was joint tenants, then it would flow to your grandmom. So, sorry. No questions. Really learned a lot from you. Thanks for spending so much time. Virginia, you're welcome. Thank you so much. See, these are the types of questions we like, is when it's not a question. It's a, hey, you guys are pretty cool. We have a C-corp, just got it last month, retired 6/30, received a year's severance, sold one property, second property, total income, 415, and you're retired. Is there any way to minimize my tax liability? Yes. So if you own the property, here's what I would be thinking of. I'd be thinking that you want to reduce any amount of tax that you have. So I might be looking at cost segregation and trying to maximize the depreciation on that one property. I'd also be looking at possibly making a contribution to a nonprofit, either by making, if you're going to be give 5 years in one shot, or 4 years or 3 years, and try to get the tax deduction this year. You can write off up to 60% of your adjusted gross income. If you're charitable because you're retiring and you want to do good, you could actually fund your own nonprofit before the end of the year. And you can, again, write off. You have to move the money into it, but you could write off up to 60% of your adjusted gross income. Or if you don't want to move the money into it, you transfer the property or your interest in the second property, and you can write off its fair market value, depending on how long you've owned that property, up to 30 or 60% of your income can be wiped out. So, and then if you just get to the end of your rope and you say, Toby, I don't want to do any of that, I would run the numbers real quick and see whether or not it makes sense to perhaps invest in a charitable conservation easement, where maybe you put in $20,000 and get an $80,000 deduction. At 415, you're getting hit pretty hard with the tax stick. If you have state income tax as well, that would really suck. And since this is your last year, and you have a year of severance, then you're getting hammered with the tax all in 1 year. All right, sorry if you answered this, got interrupted. I want to make sure I understand about deductibility broker fees. I create an LLC which holds the account, create a C-corp which is a member of the LLC, and the C-corp pays a guaranteed payment. C-corp pays the brokerage fees. Is this correct? Yes, very good. You just nailed it. Can a 69-year-old contribute to a Roth IRA and enjoy its earnings tax-free in 5 years?
A 79-year-old can contribute to a Roth IRA.
Yeah, there's no age limit on a Roth. It's only the traditional IRA. You can even contribute to a pension or a 401k, even past. Holy buckets! You guys are dedicated. Go home and be with your families. Very good. See, I like that. So it's 5:09. Sorry, Jeff. I always tell him it's going to be an hour, and then it's not. But he falls for it every Tax Tuesday. So whose fault is it?
So if I was supposed to call you today, blame Toby.
Yeah, that's right. We have a couple of ones to go over. Anyway, thank you. Merry Christmas. Happy holidays.
Merry Christmas.
And don't spend too much time worrying about taxes. Taxes are because you're making money, which be very, very happy and blessed, and give a lot of it to those who have trouble making it. Millionaires are trustees of the poor. If you're good at making it, then you better take care of those who aren't so good at making it. Don't, of course, just say that tongue in cheek, and also partially because I believe it. Don't give it to those who don't deserve it. Give it to the poor people that are really suffering and through no fault of their own. Gosh, we've had people washed out of their houses, burned out of their houses, shot out of their houses. There's so much going on, so just do your part. If you reach any of those people, do what you can. Merry Christmas otherwise, and we'll see you next year for the next Tax Tuesday.
Have a good New Year's and a good Christmas.
All right. Catch you guys.